Hi everyone, and welcome to today's webinar, Is a Self-Managed Super Fund Right for You? Thank you so much for joining us. Today we are lucky enough to be joined by three expert speakers: Natalie Vukovic, a senior accountant here at VI Partners and a specialist in the SMSF space, financial planner Jeff Yakub from Argent Street, and finally Romeo Velado, one of the directors here at VI Partners with over 30 years of experience. A quick disclaimer before we get started, just a lot of important information. The information in today's presentation is general information only and is not intended to be a recommendation. If you have any questions or require any further clarification on this, please reach out to our office. In today's session, we will take you through exactly what a self-managed super fund is, the setup process, any associated fees, important things to consider, when it is appropriate, and what you can and cannot do. So let's kick things off by welcoming our first speaker for the day, Natalie Vukovic.
Thank you very much, Lauren. So we've organised this SMSF webinar today mainly because it's become such a growing industry and everyone's heard about them to some extent. Some of the stats recently released show how popular they have actually become. There are over 603,000 SMSFs holding $869 billion in assets, and there are more than 1.1 million SMSF members around Australia. SMSFs had assets rise up 15% from the previous year and 25% over 5 years, and 64% of SMSFs have existed for more than 10 years. So you would all be quite familiar with the traditional industry and retail super funds that are out there, such as Australian Super, CBUS, REST and HESTA, for example. Similar concept, but the main difference between these funds and an SMSF is who manages and is responsible for it. Those super funds I mentioned earlier are all managed on your behalf, and the managers decide where to invest your super money based on your preferred level of risk. An SMSF, as the name suggests, is managed by you, being the trustees and members of the fund, and you ultimately decide what kind of investments you want to direct your money towards. You are also responsible for complying with Australian superannuation and taxation laws. SMSFs are widely recognised as offering greater control and flexibility over investment choices, and Romeo will go into a little more detail later on in terms of what an SMSF can and can't invest in. The rules are still very much the same though in terms of when you can access your super, regardless of whether it's in an SMSF or an industry retail fund. Although an SMSF does have the advantage of being able to invest in residential and commercial property that these other funds can't do. Romeo will speak about this in the last part of the webinar. While these benefits appeal to many people saving for retirement, there are a number of issues and risks that you need to consider before deciding whether an SMSF is right for you. An SMSF can have one sole member, or it can now have up to 6 family members that can pool their super together and invest jointly in assets. Your existing super balance in HESTA or REST, for example, would get rolled over into the SMSF. And even though a family group are investing together, we still keep track of each individual member's balance separately. So each member's portion of the fund is dependent on initial balances as well as contributions made along the way. The earnings the fund generates, whether it be from rental income, dividends from shares, distributions from managed funds, or even interest earned in a bank account or term deposit, are all taxed at 15%. When a pension is started in an SMSF, the tax rate drops to 0%. So in terms of comparing the tax rate applicable to an SMSF against a company or your own personal name, it is still considered possibly the best tax effective environment to have your money in. Although the recent change in legislation the current government are putting forward about taxing those people who have more than $3 million in super would result in a 30% tax rate on any balance above that threshold. Contributions going into the fund from either your employer, who currently has to pay 10.5% of your wages into super, or personal contributions from your own money outside super being claimed as a tax deduction, will also attract a 15% tax, which the super fund pays itself via tax return lodgement. When a member reaches retirement age, there are opportunities to start an income stream or pension where you finally get access to your hard-earned money. There are currently two types of pensions, one that can be started while you are still working and the other that can be started when you retire. Reaching what's called preservation age is still required for both these pensions, and preservation age for most of us would now be 60. Keeping in mind that preservation age is not the same as pension age, like for Centrelink purposes. As I mentioned earlier, when a pension is commenced, the super fund is exempt from paying tax on that portion that is in pension phase, so a 0% tax rate applies. Next, I'll go into a bit more detail on what's actually involved in setting an SMS up and to get it fully functioning. The first step before anything is actually set up is to have a sit-down meeting with us at VI Partners to discuss your intentions in having an SMSF. If you want to proceed with the establishment after this initial discussion, a statement of advice will need to be prepared by a licensed financial planner, such as Jeff, who is presenting in this webinar. The purpose of the statement of advice is to define your overall superannuation SMSF strategy. And since 1 July 2016, any person who provides financial product advice must prepare and provide a statement of advice. Once this has been documented, in order to establish any trust, which is what an SMSF ultimately is, a deed needs to exist. The deed is a legal document that sets out the rules for establishing and operating your fund. It includes such things as the fund's objectives, who can be a member, and whether benefits can be paid as a lump sum or income stream. The deed forms the fund's governing rules, which also need to be in line with superannuation laws. An important decision that needs to be made at this point is whether you will have individuals or a company acting as trustee. The trustees control the SMSF and make all the investment decisions. There are pros and cons to both of these options, including cost considerations, and we will assist you in working out what's best in your particular situation during the setup process. But generally, we would recommend a corporate trustee because it's more beneficial for the longevity of the super fund. A sole member SMSF has no choice though, and needs to have a company trustee in place because you need a minimum of 2 individual trustees if you're not going the company route. We use a third-party legal firm who prepares all the documentation required for the creation of the SMSF after you've decided on a name and who the members and trustees will be. We also apply for a tax file number and ABN on your behalf. Once all legal documents have been signed, the next step would be to set up a bank account in the name of the SMSF. The onus falls on you, the trustee, to liaise with the bank of your choice to get this done. There's no right or wrong here in terms of what kind of account you should have, but any transactional account that can accept deposits and allow you to make payments, that has low to no fees and maybe earns a bit of bank interest would suffice. Keep in mind that although you will easily have access to this bank account via internet banking, it is restricted money and belongs to the super fund and therefore should absolutely not be touched or used for any personal reason. Only SMSF related income and expenses can go through this account. So it is to be kept completely separate from any other bank account that you have. The penalties involved in breaching the superannuation laws are quite severe if money is used incorrectly. Once the bank account is opened, you would then initiate the rollover process, which is where contact is made with your existing super funds, again by you, the trustee, and a request put in via the required forms to transfer some or all of your current balance into the SMSF's bank account. As soon as all members' funds have hit the SMSF bank account, you are then ready to start investing in your preferred asset class or classes, whether it be purchasing Australian or international shares, commercial or residential property, or other allowed investments. At the end of the financial year, a set of financial statements and tax return needs to be prepared to reconcile all the ins and outs and calculate member balances. The income tax is also worked out at this stage, and payment of the tax is made by the SMSF from its own bank account direct to the tax office. Prior to submitting the tax return and making payment to the ATO though, the transactions and documents need to be audited by an independent party to verify that your fund has complied with all superannuation legislation. Documentation is key with SMSFs, as the auditors can ask for practically anything to verify activities during the year and generally require all bank statements, receipts and invoices, signed contracts, and dividend and payment advices. Once the audit is passed, we send paperwork out to you for signing and lodge the tax return. There are quite a few steps involved, as you can see, but rest assured that we will go through each in detail with you at the time. In terms of the fees involved, initially there will be the statement of advice fee paid to the financial planner, and then the establishment fees paid to VI Partners. Statement of advice fees start at $3,700 plus GST, with the average around $4,400 plus GST. Deed establishment fees will be $2,200 plus GST for an SMSF with a corporate trustee, and $1,800 plus GST for the less favoured SMSF with individual trustees. Because the SMSF is not set up and a bank account doesn't exist in its name at this point, you will have to pay these initial costs from personal funds first. But once the rollovers have occurred and the SMSF has the money, you can reimburse yourself these fees at a later stage. There is another entity, another company structure that may need to be set up at the same time as the SMSF, which is only required when the super fund is needing to borrow money to fund a property purchase. This is called an LRBA, or limited recourse borrowing arrangement, and this attracts another $2,200 plus GST setup fee. If you have enough cash in the SMSF to purchase the property and borrowing is not required, then there is no need for this other company and there would be no extra charge. The ongoing fees that you need to be aware of are annual compliance, which is preparation of financial statements and tax return. This is all going to be dependent on how complex the SMSF is and how much time is spent completing your file. So it will be on a fund by fund basis, and we always send a quote before we do the work. However, as a guide, the fees would start from $1,800 plus GST for a fairly basic fund, with the average being around $2,500 plus GST. Other annual fees, which include the audit, ATO and ASIC payments, you can expect between $800 to $1,000 per year. So for an average fund, the ongoing fees will be in the vicinity of $3,500 per year. And for a fund with a balance of around $300,000 in it, this equates to just over 1%. Keep in mind that you are being charged management or advisor fees wherever your super is currently invested. It's just all mixed in with your earnings and tax to give the end member balance. So it might be a good idea to have a look at your annual super statement breakdown in order to compare the cost difference. That's pretty much it for me. So I'll pass you on to Jeff and he'll take you through the next section.
Thanks, Nat. I'm going to start off with some of the fun stuff, and really it's just addressing what superannuation is. And super effectively needs to meet the sole purpose test. So this states that a super fund must be maintained for the sole purpose of providing benefits to its members upon their retirement. The only difference here is if the member unfortunately passes away, then it also has to provide a provision there. And there are two distinct parts here. It's the core purpose and the ancillary purpose. We're going to focus mainly on the core purpose today because the ancillary purposes are actually being discussed at the moment, with the Albanese government wanting to provide further legislation around the objective of superannuation. This is putting more emphasis around superannuation being solely for members' benefits at retirement and stopping access to it for such things as buying a first home or even where people access their super during the COVID-19 pandemic. So when we look at the core purpose, as I said, the two provisions there are the provision of retirement benefits for members or the provision of benefits on or after a member's death. And when we look at the application of the sole purpose test, we can often see self-managed super funds fail because there is no retirement purpose behind their investment decisions. That's why it's very important right at the start that we remember it's not the type of investment that you do within your self-managed super fund, but rather the purpose for which that investment is made and maintained that is relevant to the sole purpose test. It's also important to remember that the test requires a higher standard than that of having a dominant purpose or a principal purpose. It is a sole purpose. The example we give here is purchasing a property. You can buy a property in superannuation, which we'll discuss further, but it has to have the sole purpose of being a provision of retirement benefits for its members. So once we've addressed the sole purpose, we have to then decide how we can adhere to that test. And the first thing we do here is establishing an investment strategy for our clients who have self-managed super funds. The investment strategy must be in writing. It cannot be something that is simply discussed between the trustees, ourselves, and VI partners. And we have to outline a number of key things. The first thing we need to address is what are the needs of the fund. So this is looking at things such as what income is required, what capital gains are required, what volatility are members happy to accept within the superannuation industry, what's the average length of time for each member until they retire, and what are the members' insurance needs within the fund. Once we've looked at the needs of the fund, we then move on to the objectives. A fund's investment objective needs to take the form of a statement, and it could be a series of statements as well, depending on if you've got different objectives. An example of an investment objective could be to state that the fund aims to generate returns of 4% in excess of CPI over a rolling 5-year period. So we get that objective, we write it down, and we put it inside your documents. Once we've set the investment objectives, we then have to decide how they will be met. The two things we look at here are what risks are we willing to accept as trustees of the self-managed super fund, and what tolerance do we have to manage that volatility over that set period of time. This includes what actions will the trustees take if the investment objectives are not being met. So if our objective was to generate returns of 4% in excess of CPI and they are not being met, it is the trustee's obligation to address this and work out what can be done. And the final step is to determine what ranges the trustee will allow for this strategy. And this refers to what level of investments the trustees would like to invest in different asset classes. The traditional asset classes are shares, property, fixed interest, and cash. It's not acceptable to simply state that you will allow a range of 0 to 100% for every asset class, because this shows that the trustee is not taking into account such things as risk, return, diversification, etc. But there is also no requirement there to actually put a certain amount in each of those asset classes. This leads us on to the option of buying property inside the super fund. And one of the growing ways people manage their super is by moving their money from an industry or retail super fund into their self-managed super fund to purchase property. When we do that, we do need to make sure that it's still addressing the investment objectives and the investment strategy. And we need to make sure that if that's the only purchase that you're doing within your super fund, that we've allocated an adequate amount of our time to addressing that and discussing whether it is the appropriate amount of risk and return. APRA, who's the prudential regulator, adds further to this, and they even ask that members have a minimum balance of $250,000 when starting a self-managed super fund. They do this to ensure that members that only have 50,000 or 100,000 aren't going to see their super funds drained by fees, insurances, and things like that. On to the serious stuff. And as I mentioned in the previous slide, one of the objectives and one of the things that a trustee has to do within a super fund is address insurance for their members. And this has been since the 7th of August 2012, where a trustee needs to specifically consider, as part of a fund's overall investment strategy, the investment needs of each of their members. The types of insurance and the levels of cover that are appropriate for each member must also be addressed, and it needs to be recorded. The trustee is required to ask questions such as how family members of the family members of the members within the SMSF would cope if a member were to pass away suddenly or have an unexpected serious illness. It also needs to address elements such as sickness and injury and an inability to work because of that. Although it can be a sensitive topic of conversation, it's very important to be aware of the potential risks of not having insurance within your self-managed super fund. And this is why one of the first things we do is ask those questions. And we look at 3 insurances. We look at life insurance, which is obviously fairly self-explanatory, where if a member within a self-managed super fund were to pass away, their beneficiaries would receive a lump sum payment. This extends to total and permanent disability, where a member might not pass away, but 2 doctors will categorically state that you will never return to work. And the third is income protection. This is where the insurer will pay up to 75% of your salary should you be injured or ill and unable to work. Most income protection policies can also include a super component. This is where they will pay effectively what either your employer or you personally were paying into superannuation to ensure that your super balance continues to grow whilst you are unable to work due to injury or illness. When we're setting up insurance, it's also important that we address beneficiary nominations. And this is making sure that if you were to pass away or become totally disabled, the trustee within the self-managed super fund has clear direction on who the proceeds of the insurance policies need to be paid to. That's it from me. I'm now going to pass over to Romeo, who's going to go through what you can and can't do within a self-managed super fund.
Now that you have a general overview of what an SMSF is and some of the issues relating to the setup and ongoing management, I just want to touch on how an SMSF can actually be used. Whatever the motivation to set up an SMSF, you need to understand that it is a big deal and there are responsibilities that go along with running a super fund. And it means that you need to be fully committed to manage your investments as part of your overall wealth strategy. In helping clients with their financial goals, one of the most important questions we ask is, how much money do you need to have annually in retirement? The answer can be different for everyone. Is it $60,000, $100,000, $200,000? Whatever the number, you need to understand what retirement will look like for you so that you can put in place a plan now that will help you build up assets to enable you to give the income you need or want so that you can enjoy the lifestyle you want in retirement. Then you need to think about how superannuation will assist you with your retirement plans and in turn, whether an SMSF is the most appropriate structure for you, because it isn't for everyone. So where a super fund can go wrong, and a lot of people when talking about superannuation, it's amazing to hear how many people think that it's something that is so far out of reach, they don't really worry about it. They don't give it serious consideration that it deserves. This attitude is actually dangerous for people that establish an SMSF because they tend to typically take higher risks than they would with their own money outside of superannuation. There may be occasions where a speculative investment pays off. However, as we know, high risks don't always pay off, which can then have a detrimental impact on the overall superannuation balance and therefore your retirement plans. Setting up an SMSF and gaining access to your money is not a free hit to make an investment that you would not normally consider. Another mistake that is often made is that people set up an SMSF with the intention of investing, but for whatever reason, just don't follow through. They might just procrastinate over a decision or just don't allocate the proper time to make an investment, or they're just not ready. So they end up with money sitting in a bank account that's generating little returns instead of possibly leaving the money where it was and maybe getting some type of return from their normal industry or retail fund. The best practice that we always recommend is don't set up a self-managed super fund until you're actually ready. So where a super fund can work well, and I'll focus mainly on property today because it is, I suppose, the most popular type of investment when it comes to self-managed super funds. And of course, it's got to, like Jeff mentioned, it's got to fit in with your overall retirement and wealth plans. The reason why it is popular is that you can't purchase property through your normal industry funds or retail funds. Some funds actually allow you to purchase shares directly, but you can't do that in direct property. And Australians have always been fascinated with purchasing property and using it for investment purposes. So it is appropriate. Whether or not you have 100% of the funds available to purchase property or use some borrowings via a limited recourse borrowing arrangement, and I'll talk a bit more about that later on. People have been able to take advantage of the capital growth and income returns that properties delivered, and especially over the past 20 years. The types of property that you can purchase pretty much is unlimited. You can purchase residential, you can purchase commercial property, and you can even purchase vacant land through your super fund. There are also instances where we've had people purchase land and use the money that they have in their self-managed super fund to develop the property and actually make some money that way. There are three main reasons why you might want to look at purchasing property through a super fund, and these are three. So the first one is running a business and you want to purchase the actual property that you operate your business from. This can work really well as it can provide certainty for your business, and at the same time it means that the rent you'll be paying is going back to you rather than someone else. Another thing is that you just want to purchase a residential property and maybe you don't have enough money outside of superannuation. You can take advantage of the rental income and capital return that I mentioned already, and it is a long-term growth strategy rather than just a short, let's make some quick dollars out of property. Another way that you can actually purchase property and use a superannuation fund is to purchase a property at today's value that maybe one day you might want to live in. Now, this will only work if you want to access the property at retirement age and you can access your superannuation money and you're happy to withdraw the value of the property from your super fund. So like I mentioned earlier, there are very few restrictions on the type of property that can be purchased in a super fund. It can be any type of property. There are, however, restrictions on who a super fund can purchase property from. So as long as it's on an arm's length basis, there's no real restrictions. But a super fund can't purchase a property owned by a member of the fund, a relative, or even a related entity like a company or a trust. The only exception to this rule is where a property is a commercial property and is being used as part of a business, and it doesn't necessarily mean your business. The other point I want to highlight is that you can't purchase a residential property and use it in any way, even if you pay commercial amounts of rent. So this means that you can't purchase that holiday house in your super fund and use it every now and again. It definitely breaches the sole purpose test that Jeff has mentioned earlier. Some people have tried to argue that the ATO will never know whether or not I'm using a property or who's renting it. Unfortunately, with the amount of information that's available these days, the ATO can get records like rental data, the availability of a property for rental from real estate agents to verify income received, and also the availability of property for rent, because it must be available for rent all the time. So our advice is if you're thinking about doing this, just don't. So I just want to explain the borrowing through a self-managed super fund. So as Natalie's mentioned, it's done through a limited recourse borrowing arrangement, and it works really well where you don't have enough money in your super fund to go out and purchase a property immediately. So the way it works is that the superannuation fund actually uses its money or what money it has available or the amount of money that is willing to allocate to the purchase of a property and goes out and buys the property. The actual title is not in the name of the superannuation fund, and it's actually held in the name of the Bear Trust, which is a separate holding entity that sits between the property and the self-managed super fund. The super fund can then go to a lender, borrow the balance of the funds, and it receives the cash to settle the property at settlement. The repayments come from the superannuation fund directly to the lender, and the rental also goes back to the super fund. The important thing to note here is that it is a limited recourse borrowing arrangement. And what that means, and the reason why the property is held separately to the super fund, is that if for any reason the repayments can't be made or there's any issue, the lender only has a recourse against the property and not other assets of the self-managed super fund. So if the super fund has other property, shares, or other investments, the lender cannot attack those if there's a shortfall with the value of the property. So the main advantages of using a borrowing arrangement within a super fund is as follows. You can use cash within super to buy property that you otherwise could not have been able to afford. And you can take advantage of capital growth on a larger asset base. So if you're getting a 10% return instead of on the $250,000 investment, and if that's all you have in there, potentially you can get a 10% return on a $750,000 investment by using borrowing. Second thing is that you have the ability to pay off your loan quickly via the combination of rental income and super contributions, whether they be employer contributions or your own personal voluntary contributions. In some instances, you can actually get a tax deduction for your loan repayments going into a self-managed super fund. If you're negative gearing, then the tax on your super contributions can be reduced. So instead of paying 15%, that tax rate can actually be reduced because the losses will offset the income of the super fund. And the other final benefit is that you can take advantage of a reduced tax rate on any capital gains made when the property is sold. So instead of paying your marginal tax rate on any capital gains, you only pay maybe 15%, 10%, or even 0% tax, depending upon where your fund is at on the capital gains. So it's a huge advantage. So with superannuation, with self-managed superannuation funds, you don't have to invest in property. This is just one of the more popular ways to invest. You can still use a self-managed superannuation fund to invest into shares, managed funds, gold, artwork, and there's a variety of other types of investments that you could invest in. It just depends on whether or not you still fit within your overall wealth plan, whether or not it's part of, and also whether or not it is allowed. There are certain investments that aren't allowed, and whether or not it's going to provide you with appropriate retirement income when you need it. So that's all for me, and I'll just pass back to Lauren.
Thank you, Romeo, and thank you, Natalie and Jeff. We have had a few questions come through that we do have time to answer today, but if anyone had any more personal questions that they would like asked, please reach out to our office and we would be happy to set up an appointment or go through these over the phone. So first one, Romeo, you might be able to answer this for me. What happens to my self-managed super fund if I pass away?
Thanks, Lauren. Well, that's an interesting one. And basically, with a self-managed superannuation fund, it depends first on how many members you have. If you're one of 2 members or one of 4 members, then basically your super fund or your interest in that super fund is handled in the same way as your other estate would be handled. The important thing to note is that you would need to put in place some sort of binding death benefit nomination with your super fund, so the trustees can actually handle your money in the way that you want it to. So that's the main way to do it. If you're the sole member of the self-managed superannuation fund, then the money has to come out and it would normally go to your estate.
Thanks, Romeo. I'll keep you in the hot seat. I've got one more question that I think you will be able to answer for me. Can I sell an asset that I have bought in my self-managed super fund?
Absolutely. Buying or any investment within a self-managed superannuation funds doesn't mean that you're committed to that investment for the rest of your life. You can buy, sell, whatever you think is appropriate, and obviously it depends on market cycles, etc. The only thing is any profits that are made on that investment would have to go back into the self-managed superannuation fund, and you cannot access the actual profits yourself personally until you reach one of the triggers as far as retirement is concerned.
Thanks, Romeo. Now we'll put Jeff in the hot seat. Jeff, I have one question for you that's come through. How do I monitor and manage my self-managed super funds performance?
Yeah, there's a couple of ways here. So it ultimately depends on the investments that you've purchased through your self-managed super fund. So if you've used your self-managed super fund to purchase property, generally speaking, as part of the ongoing audits, we get the property valued independently every 2 to 3 years. And that allows you to actually have a reasonable understanding of where the balance is and what the performance has been of the property. If you're looking at purchasing things such as shares, that's where it depends once again on whether you go through an advisor or you do it yourself. You might do it through your own online trading platform. If you do it through an advisor, advisors traditionally use something we call a wrap, or it's a platform, and that allows us to buy and sell securities on your behalf, and also provides things such as consolidated reporting, and that usually allows us to generate performance reports from that. And then it just really extends on to further unlisted assets. So if you're buying, gold and things like that, then it's probably a bit more manual, but we do have to just keep tracks of what the actual listed value of that would be and how much do you hold, and we can report back that way.
Perfect. Thank you, Jeff. And that's all the questions that have come through today. So thank you everyone for attending today's webinar. We really appreciate your participation. We do have a survey that we will send out post-webinar that we would appreciate you complete, just to take on any feedback that you may have. But once again, thank you so much on behalf of all of our key speakers today, and we hope to see you next time. Thanks, everyone.